So what if paying cash for cars was one of the most expensive options for buying a car? Today, what we're gonna do is we're gonna break down how you can buy cars more efficiently, how you can actually get every dollar back for every car you ever buy, drive, and own by changing one thing and adding one step. But if you think that we're gonna teach you how to pay cash for cars, that is an opportunity lost. We're gonna show you a much more effective way that puts you in control, keeps your money working for you 24/7, and allows you to have all the cars for you, your family, and your kids, and how to get all the money back for them. We'll see you on.
Today, we're going to be talking about financing. So how we pay for the big things in life, starting with the one and almost every single person in this room buys over and over again, which are cars. And I'm going to open up with a question that's going to sound almost backwards. What if paying cash was the most expensive option? You guys ever thought about that before? Because most of us were raised on one rule here too. Pay cash, avoid paying interest. That's smart, responsible, and the way to go. And it feels airtight. But today I want to show you a cost hiding inside that word free, a cost nobody put on the sticker. And then we're going to add it up across a lifetime of cars. And I think the number is really going to surprise you all. As always, two parts. First, we'll redraw how you think about paying for things. Then we're actually going to teach you the mechanics of it so you can run the math on your own for your very next purchase. So let me introduce you to the guy that did it the right way his entire life. But like always before that, just a quick little disclaimer for everyone on here. This is a presentation is for educational purposes. We are not giving any true financial advice on this webinar and all the rest of it. I think everybody also saw that when they logged into Zoom. So with that said, we're going to keep on rolling here, guys. All right. All right. So here's Tom. Tom is proud of exactly one financial fact above all others. He has never, not once, financed a car in his entire life. Every few years, he walks into the dealership, writes a check for the entire thing, and drives off owing nobody else a dime. No payments, no interest, no bank in his business. And honestly, good for Tom. He avoided every finance charge, every dealer markup on the loan, every let me talk to my manager. By the rule we were all handed, Tom is the gold standard, the responsible one we're all supposed to be. So let me ask the question that's going to run this whole session, the rest of today's Zoom. No payments, no interest, no bank. What could possibly be wrong with that? Hold that thought because the answer is the entire point of today. So here's the part that Tom never saw because it never showed up on the check. So here's what Tom never saw because it was never anywhere that was actually written down. The moment his cash left his hands, something left with it. Everything that money could have earned him for the rest of his life. Think about that. As soon as that cash went to buy that new car, that money's now gone from his life forever. He can never use it for anything else. So that $40,000 didn't just buy a car. It also stopped being $40,000 that could grow, that could compound, that could be there for an opportunity that arises, or even used in an emergency. It's gone, not to interest, but to opportunity. And unlike a finance charge, nobody sends you a statement for that. There's no bill, there's no line item, there's no monthly reminder. It's completely invisible, which is exactly why it's so dangerous. And remember, Tom doesn't do this once. He does it every few years for a lifetime of vehicles. The check always shows him the price and never once showed him the actual cost. So the real question about financing was never the one we were taught to ask. And let's take a look at this, what this looks like. Craig, I know you like to talk about this. You want to pipe in just for a minute?
Sure. Yeah, this is something that I like to share on my strategy calls because everybody's familiar with buying things with cash. And I actually had a strategy call with a guy yesterday, and he said, I've been doing infinite banking, but I've been using a savings account. He says, I paid cash for my car, but then I asked what the finance charges were, and I just paid that amount back to my savings account. And I said, well, there's some good news mixed in here. One, you kind of understand the mechanisms of the process, but here's what's going on. Let's say that you are the type that saves your money in a savings account and it's time to go buy a car. Let's say that, Tom, we're using Tom, he had $40,000. So Tom's going to save up his $40,000. As soon as Tom pays that $40,000 to the dealer, and we're looking at that save and spend graph, isn't he right back at zero? So he saved up his 40, he spent it, he's at zero. Well, Tom's going to save up money again for his next car, maybe 5, 6, 7 years down the road. And throughout his life, he's going to continue to go up and down, up and down, and up and down, right? So he's going to save and spend, always end at zero. Now, there's another group out there that maybe, we're at the point where, hey, I need a car. I have to get to work. I have to go places, take the kids to school, but I don't have the money. So what are we going to do? We're going to go to the bank, we're going to go to the dealership, and we're going to finance that car. So we're now in borrow, then spend. And what's going to happen is we're going to spend the next 5, 6, 7 years paying car payments back to the bank or the dealership. Now, guess what's common between the save and spend person and the borrow and spend person? They always end up at zero. It's right there on the graph. They always end up at zero. They have nothing built in terms of wealth. So what we're going to I'm not going to spend a ton of time on this last one where it's save and spend, but what would happen if you could put your savings somewhere where you could save it and spend it and pay it back? So you see those little blue jaggedy lines on the third graph, the save and spend. That's just representative of us putting our money into this place that we're going to talk about today. It continues to grow uninterrupted. We leverage it, pay it back, leverage it, pay it back, leverage it, and pay it back. Now, something cool that I want to show later is along that green arrow where we're compounding continuously on that save and spend, that third graph. I'm going to show you how we can actually find out if you were to finance your own car or any major purchase for that. We're going to show you what that number looks like for a particular policy design. So we have some strategies of how to show that, but just kind of look at these different graphs and identify, where am I? Am I a save and spender? Am I a borrow and then spend? Or maybe I'm one of those two and I'd really love to learn how to do the save and spend. And that's what we want to teach today.
Absolutely, Greg. Yeah. And if you like that idea of save and spend, stick with us because that's exactly what we're going to get into. It's a little what they call foreshadowing, right? All right, cool guys, let's roll. So let's swap the question for just a second that we were talking about, like we do every single week on this series. So for most of our lives, the only question we asked about a big purchase was, how do I avoid paying all that interest? And avoiding interest feels like it's winning a lot of the times. It's why people use cash. It's simple, it's clean, it's what Tom does. But here's the better question to ask. The financially efficient actually ask, the people that actually, understand how money works. And that's what we're trying to teach everyone here. So that question is, how do I keep my money working while I use it? Not how do I dodge the finance charge, but how do I get the thing I need and keep my capital doing its job? Because here's the truth, those two questions start to expose. Avoiding interest is easy. Anybody can do it. Just hand over the cash. Keeping your money working while you still get what you need, that's the actual skill. That's financing efficiency. And it starts by being honest about something that nobody ever told Tom. And the honest thing is this: there is no free way to pay. There's no free way to pay. Think about that. There's only the cost you see and the cost you don't see. So nobody ever told Tom paying cash isn't free. Let me prove it with real numbers here. Tom's car had a price of $40,000, but that 40,000 didn't cost him 40,000. It cost him 40,000 plus everything that money would have earned if he'd kept it working. Look at the bars on the screen. The green bar is what he spent, 40 grand gone. But if that same 40,000 could have earned even a modest 6% a year, then 5 years later, it would have grown to about $53,500. See that orange bar on the screen, roughly $13,500 is growth Tom quietly gave up when he used cash. He didn't really spend 40 in future dollars. He spent closer to 53,000. Now, I want to be fair and clear. This is illustrative, and the exact number depends entirely on what your money could actually earn. I'm not promising you 6%, and this isn't financial advice, but the principle holds no matter the rate. The car costs the same either way. Paying cash doesn't erase the bill, it just hides it where you'll never see it. So now put the two ways side by side, and something starts to click. And the whole thing really comes into focus. Here's the honest framing of a choice nobody frames honestly for you. If you finance, you pay interest. That's a real cost. But notice it's a visible cost. It's right there on every statement staring at you, impossible to ignore. And because you can see it, you respect it. You maybe even fear it. If you pay cash, however, you give up interest. The growth that money could have earned is gone. That's also a real cost, the same kind of cost, but it's invisible. No statement, no bill, no monthly reminder. And that's the trap. A cost you can't see is a cost you'll happily pay for the rest of your life, feeling smart while doing it the entire time. So here's the takeaway, and it's the heart of financing efficiency. There is no free way to pay. Smart money doesn't waste energy chasing no cost because that option doesn't even exist. Smart money chooses the smaller cost on purpose with its eyes wide open. Sometimes that's paying cash. Sometimes it's financing. The point is you get to actually decide instead of being fooled by the one that hides the bill. Now let's do the thing that nobody does, add it up across a whole lifetime of cars. The average person buys or replaces a car about every 6 years. So from your mid-20s into your 60s, that's roughly 7 vehicles. Look at the timeline, 7 purchases, one after another for decades. Now, here's the key insight from everything we just learned. Every one of those purchases carries a cost, and it doesn't matter whether that cost shows up as interest you paid or as growth you gave up by paying cash. It's a cost either way. And handled carelessly, high rates on one side or dead cash on the other, that cost quietly compounds car after car into the 6 figures. $100,000 or more gone to the way you bought cars. Sit with that for just a second. The way you handle your car money repeated over a lifetime is genuinely one of the biggest wealth decisions you could ever make. And almost no one treats it like a decision at all. They just do what they've always done 7 times in a row. So if every path has a cost, how do you actually pick the smart one? And I'll add on top of the 7 cars over and over, how many of you buy cars for a spouse, for your children, additional vehicles? You know, this really starts to compound when you look at it that way. So if there's no free way to pay here, how do you actually make the call? So here's the framework. 4 questions that replace the old cash or finance rule. Run any big purchase through these 4 questions. Number 1, start writing this stuff down again, guys. Number 1, total the real cost. If you'd finance, add up all the interest. If you pay cash, estimate the growth you're giving up by using that cash. Compare those honest totals, not the sticker price, the real cost of each path. Number 2, compare the spread. This is the heart of all of it. Does the loan cost less than what your money can safely earn or protect somewhere else? If your money can reliably do better than the loan costs, financing might actually be the cheaper path. If it can't, cash probably wins. Number 3, protect your liquidity and control. Don't take every dollar you have and bury it in a car that's losing value the second you drive it off the lot. Keeping cash accessible has real value. The value we've talked about every week, and the sticker price completely ignores that. And number 4, pick the smaller cost on purpose. Sometimes that's cash, sometimes it's financing. I'm not here to tell you which. That depends on your rates, your returns, your situation, and it's a conversation for a professional. What I'm teaching you is to decide with your eyes open every single time instead of on autopilot. And notice a financing decision was never really about the car. And if we step back, here's where cars snap back into the bigger picture. A financing decision was never really about that car. Watch the wheel here. How you pay for one vehicle reaches straight into your cash flow. That's your monthly breathing room. It touches your liquidity, how much you can get to. It touches your growth because of the money you kept working, that money kept working or it didn't. And it touches every future opportunity because the capital you buried in a depreciating car is capital that can't say yes to something else. So financing efficiency was never really about cars at all. It's about keeping your capital working across your entire financial life. Every purchase, every year. One more time. Keeping your capital working across your entire financial life. And that reframes the whole question one final time. The smartest way to pay isn't the one that avoids interest, and it isn't even the one with the lowest sticker. It's the one that keeps the most of your money working. So let's name the shift that just happened. The goal is to keep your money working. And I want to take the judgment out of this in both directions. You are not automatically smart because you paid cash. Ask Tom, who gave up a small fortune feeling responsible the whole time. And you are not automatically foolish because you finance something. Plenty of wealthy people finance on purpose, precisely because their money is doing better work somewhere else. What actually matters is just this. Did you choose the smallest cost on purpose? And did you keep your capital working while you still got what you needed? And unlike a lot of money goals that take years, this one you can actually act on right now immediately on your very next purchase. Next time, before you reach for your checkbook or the loan application, you'll pause and run the spread. That pause is the whole skill, which leads to one last irresponsible question about all that interest. Look at every path we drew out today. Financing, the interest goes to a lender. Paying cash, the growth you gave up goes to a market you weren't in. Either way, the cost of buying your car leaves your world and lands in somebody else's pocket. But think back to the banking system we introduced a couple weeks ago, where you can finance a purchase from your own capital, pay the interest back to yourself instead of the bank. Put that together with what we learned today, and imagine that. And we're going to get to this in just a second. Buying your next car in a way where the financing cost lands in your pocket. You become the lender. You capture the interest you would have been paying away to somebody else your entire life. And I'm not going to pack exactly that today. We're going to show that in just a minute. Okay. So we are going to get into that, but hold the questions, because once you've asked, what if I could be the one financing it, writing the check to the next dealership never quite feels the same way. So if you want to run your own numbers, here's what we're going to do, guys. We're going to be able to, we're going to show you some examples here in just a minute and exactly what you're going to want to write down yourself. And we're going to go through this with you. Okay. So let me explain that. Today's question, we kind of changed it from how do I avoid interest to how do I keep my money working while I use it? That thinking is universal, but your numbers are yours. Remember that. Your rates, your purchases, and what your money can actually earn. So the next step, if it's useful, is to sit down and run the real spread on the next big thing you're going to buy. So write that down, guys. Write down something that you think you're going to do. If those of you that wrote yes, you're going to buy a car, let's start writing this down. If you have another major purchase, something for your house maybe, equipment for your business, write that down and we can use those examples, okay? So the true cost of paying cash versus financing it is your specific situation and what we want to clarify. It's a personal conversation. It's not a purchase. There's no pressure, nothing pushed, anything like that. And to be clear, nothing today is financial advice. It's education. So we want to talk through your situation and what that looks like. So I'll leave you with the line I hope you carry out with you for the rest of your lives. There is no free way to pay. There's only the cost you see, the interest, and the cost you don't, the growth you give up. That's it. Those are the only two options. And one of them has been hiding from you your whole life. So here's what changes starting today. The next time something big has a price tag on it, I want you to look for a second price tag, the invisible one, written in terms of what you'd have to give up to pay cash. Once you can see both, you can finally choose the smaller cost on purpose and keep the rest of your money working for you instead of working for somebody else. Because as it turns out, free was always the most expensive word in personal finance. And now you can see the actual price. And with that said, Chris and Craig, let's get into this.
We just kind of gave you a really good foundation to start on, and then I'm going to have Craig go into the math. It's funny because, back in the day, this was always conceptual. The infinite banking concepts was always a concept, and it's a very meaningful concept. But we wanted to go in, and more specifically, I should say, Craig wanted to go in and prove it mathematically. So we're talking about cars, which the reason we talk about cars here is because everyone drives them. And pretty much to get around to do like your job and do everything else with the kids, you got to have a car, and your family needs cars. So it's just one of those almost staples that most people need unless they're in a metro. So when we're talking about buying cars, we just outlined there's different ways to buy cars, but cash could be one of the most expensive because you're giving up that earning opportunity. Now, not always. You got to do those 4 questions, and we put those in the chat. And I want to just kind of frame this up like as simple and as fast as I can. And I'm just going to use somebody that has $40,000 in a bank account. Okay. They saved this money up. It's in a high yield savings. Let's just say it's in a, 3% high yield savings account. And the intent was to buy a car. We do this all the time. And Craig actually can probably show this. If we get a chance to talk to them, here's what we do. We don't tell them, we show them the math. And what we would say is, okay, what if we just propose this idea? What if we moved this $40,000 that you have sitting in this savings account into a specially designed and engineered whole life? Now, a lot of times when we say that to a client, a specially designed whole life, the only thing they heard, they missed specially designed and they heard whole life. And they're just thinking that's the worst place I could put money. But if you consider all the things like the guaranteed interest, the dividends that every one of these mutually owned insurance companies pays on these specially designed whole life, the private nature, because it is 100% private, nobody knows about it. It is tax advantaged, or the cash value grows tax free with the way we build them, because we build them within the MEC rules, which is the IRS rules, and they provide a death benefit. Then a lot of times people would say, yeah, but I'm earning 3%. And I would come back and I would say, yeah, these insurance companies pay 5.9 to 6.6% dividend crediting rate. Now, that isn't what you take home, but any scenario, and Craig can probably show you, any scenario we look at, you're going to make probably right around 5 to 5.5%. And that is kind of looking at a period of time. That's going to be your internal rate of return. That's about what these policies make. So unless you've got a place where you can earn pretty close, it's not 100% guaranteed, but 5 to 5.5% with pretty much no risk, okay, in a tax-free environment, protected against judgments and liens in most states, that gives you a death benefit, then I think we found a better place to store our money. So that's kind of the argument. So that's not even the most important thing, because what we would then do is, and let's just use this example. Let's say the person moves the 40,000. They would have to, here's the downside to doing this with the specially designed whole life. It's not just a one and done. They can't just put the 40 grand in and be done. But I don't meet many people, especially people looking at the infinite banking concepts, that aren't saving money. They're usually saving money somewhere. So let's just assume that this person with the 40 grand was also saving $6,000 a year. I'm just going to use that. Okay. They're saving $6,000 a year. Well, we're going to redirect where that savings goes. We're not going to put it into this bank account earning 3. We're going to put it into this specially designed whole life where they get a better return in a tax-free environment. Plus, they protect their family. So let's just assume that this gives them a $500,000 death benefit to protect their family for their whole life. Now let's get to the car. We're going to come over here. We're buying a $40,000 car. Now, there's a couple considerations you have to do here. First off, when we have the money sitting in the policy, the money is going to continue to compound whether the money's in there or not. So what I would propose to this person or this client, I would say, okay, let's take $40,000 out of the policy. And just so you know, in this scenario, you could pretty much do this immediately in the first 30 days. So let's just say you're at the dealer, you found the car you want, you're going to pay cash for it. You watch this webinar and you're like, wait a second, maybe I shouldn't. Like the outside of the underwriting part of it, if you had a funded policy today, like if you put the money in today, it could be a couple days, but it'd be immediately in the first 30 days, you could pull this money out. So we're going to take a loan from the insurance company for 40 grand. Now, I know you're just like, well, why would I take a loan? Remember we said cash is one of the most valuable things, and the earning potential on that cash is very important. If you took the 40 grand out of your account, you stopped earning the 3%. But if you did it into the policy, that 40 grand or whatever the cash value is continues to compound because you didn't take your money. You borrowed 40 grand from the insurance company. And how did the insurance company give you the 40 grand? Well, it wasn't because some other depositor deposited money in the insurance company's account. No, they don't operate like banks. The 40 grand came from the death benefit. You see, the thing a lot of people don't know about life insurance is life insurance companies do not operate like banks. This is an important thing. So kind of grab a hold of this. Banks, they effectively use our money. We deposit money in the bank. The bank then has to, they got this whole thing with the way that the fiat works, but nonetheless, they take that 40 grand and they lend that out at a higher rate. It's not even their money, and they make a spread. So we want to mimic what a bank does. But here in the insurance company, they have to have the $500,000 or be able to show that your amount that you're putting in will give them the $500,000 that they promised to pay the day you die. They have to have that money, and it isn't someone else's money. Okay, so the insurance company looks at that loan as a prepayment of your death benefit. So if you died the very next day after taking this $40,000 loan, you haven't even bought the car, something happens, you die. Your family would not get 500, they get 460 because the insurance company lent you money from their general account. That money in the general account was earmarked to pay your death benefit the day you die. And that hopefully doesn't happen. You don't die. So now the insurance company's covered. They use your 40 grand that you put in the policy as collateral. So it's a collateralization that is then using your death benefit. They're going to charge you interest. So let's just assume that that interest rate is between 5 and 6%. I just want to kind of use that because they don't do this for free. But remember, what did I say you were earning on your money? Let's just assume that it's 5.5%. I'm just going to use that number. Let's just say that's your return you're getting on your money in the policy. If it cost you 5%, and we have companies that are actually under 5 right now, but if it cost you 5% to use your money, but you were making 5.5, are you not making a spread? You are. But that's small, right? You're making 0.5%. I know people are like, oh, I wouldn't even do this. It's not worth 0.5%. Just stick with us. Craig will show you it's way more than 0.5%, but you got to understand the basics. We want to act as if we are the bank. We want to do what a bank does. And that's how banks make money. They make a spread. Okay. So now we got the 40 grand. We take the 40 grand, we buy the car. But before we do that, we had done some homework and we had looked at how much that dealership would have charged if we were to have financed it through them. So let's say that $40,000 car, they were going to charge 7%. Actually, let's be fair. Let's give it 6% interest. And that that was $700 a month. I'm just making numbers up here. Let's just assume that's the math if you were to finance it. Now, you're not financing it. You are using your banking policy to finance the car. So if your money, which trust me, this should be the case, your money should always be as important as their money, the bank's money. So if you were willing to pay the bank 6%, $700 a month for the car, you should have no issue with paying yourself $700 a month. So what we're going to do is we're going to set up a bill pay. The car is already bought. You paid cash for it, but it was cash from your policy. That 40 grand is still in the policy earning uninterrupted compound interest. Now we have $700 a month coming back over into the policy. Now let me just do some quick math here. And then Craig will do the math way better than I am, but I always like kind of just getting you guys warmed up for the big show, which is the Craig show. If you did this for 12 months, that would mean $8,400 would be the amount that you would pay back for this car. But we're not going to leave it in the bank. We're going to do a loan repayment, and we're going to recycle and recapture that $700 a month back into the policy. Now, why would we do that? Well, let's just do the math. Okay, you took a loan for $40,000. The insurance company charged you 5% on that. So that's 0.05. That's $2,000 in cost, which you don't care about. Okay, this is the interest charge. That's going to the insurance company. You don't care about that because you earned more than $2,000 on your cash value in the policy. Stay with me on this. Now, every month you're putting $700 back into the policy, which means every month you are reducing the principal owed to the insurance company. The insurance company does not charge you interest or principal on a monthly basis. They charge you interest one time per year. Matter of fact, the insurance company does not care if you ever pay the loan back. It just becomes a profit center for them. They're making interest on money, so they don't care if you pay it back. They're covered when you die. They get paid back then. Okay, so that's an important thing. I've never seen a bank that doesn't care if you pay the loan back. They all care that you pay the loan back. Your bank, you make the rules because you control the money and the destination. But now let's just do the math. So remember, after 1 year, we have put $700 a month back into our policy. The coolest part is you have access to that $700 every time you put it back into the policy. You lost no liquidity of this. The $700 over here, if you had paid it to the car dealership, you don't have $700 in your account every month, and it is never coming back. Here, the $700 you're putting back in the policy, you have $700 every month to use if you need it. But now we have reduced the payment. So 40,000, or the amount owed, 40,000 is what we owed. We were paying 5%, which we know if it were for 12 months, it would have been 2,000. But now after 1 year, we have paid that loan down to 31,600. This is important. This is the difference between an amortized loan and a simple interest loan. They're charging you interest only on what is left. So now let's figure that out. Times 0.05, that's $1,580. $1,580 divided into the 40,000, that means your APR, your effective percentage yield that you gave to the insurance company was not 5%. After 1 year, it was only 3.95%. Give or take a couple percentage, or basis points here. Craig will show you the real math. And then if you did this another year, another 8,400 comes off. How much is your yield? Less. Or how much is the interest you gave the insurance company? Less. Every year is less, but you lost no liquidity. You controlled it all, and your money continues to grow. So now you made a spread of not 0.5%. You made a spread between 5.5 and 3.95. And next year, your spread will go up. And the year after that, your spread will go up even more than that. Plus, you maintain control and access and liquidity of all of your money because you're repaying your bank, not their bank. So that's all I had to say, but that's effectively just a simple way of looking at the infinite banking concept. I always describe it as a circle. Money starts here, goes over here to go to work, financing all the things you would normally finance or buy in your life. Cars, cell phones, remodels of your house, exercise equipment, and the dreaded credit card, which we have great debt repayment strategies. But Craig, I've talked too much. Let me turn it over to you and have you show them the real mathematician.
The real math.
Real.
All right. Well, I think it's always great when you go through the circle because that's the visual. Now we'll show you some of the math in the background. So I'll share my screen out here. All right. So we're in the vault. And as you were going through this, I was thinking, do we want to take just a couple quick minutes to talk about what's the difference between Dave Ramsey traditional whole life that he hates versus how we do it?
Yeah, do you want to take a stab at that?
Yeah, I'll run through that real quick like here. I think it'd be good because we do have a lot of newer people with this. So let's hit that and then we'll go into the details on the car purchasing. So like Adrian was asking, is this about life insurance? It is, and a lot of times when we talk about life insurance, all of a sudden it's time to, shut this webinar down. Let's get out of here. This is those stupid whole life policies that Dave Ramsey hates. Here's what's going on, and this is really, really important to catch on to, is what I'm showing you right now is a policy design that, let's just call this kind of what you would get in traditional whole life, meaning I've gone down the street to my State Farm rep or whomever it's going to be, and I said, hey, I want one of those whole life policies. So let's just say, for example, at the end of year one, you would have put in around $10,155 of premium. So that's what you're saving into the policy. Now, a lot of times you're going to hear, oh, well, you won't be able to get any cash out of these policies for years. That is true in traditional in the way traditionally designed whole life policies work, but in the way we do it, that's not true. And I'm going to show you that in a moment. But let's just say I put in $10,155 of premium, and I'm going to go way over here to this death benefit, $846,000. All right. So just kind of keep a mental note of the fact that we have 10,000 of premium, we have an $800,000 death benefit, but look what happens over here. We have no cash value. Cash value is that ledger amount of how much we have available to use. So if we're trying to create a banking system, because we teach the infinite banking concept system or process, if I'm putting $10,000 into this box and I have nothing to use, well, that's not a very good system to use. That's not a very good way to take control of my money and be able to go finance things. But say, hold on, just wait a minute, because if you put in another 10,000 in year two, well, you still have nothing. By the third year, we've put in over $30,000, and now we start to see a little cash value growth. So this is where you may have heard in the industry that you can't fund a whole life policy. It takes forever to get cash out. And this is what I'm showing you. It's true that if you fund a traditionally designed whole life policy, you're going to continue to put in this premium and have very little cash until you get down to here, maybe year 17. You put in a total of 172,000 and you finally have 174,000 available. We're at that kind of cumulative break even.
Hey, Craig, can
So
we use this as a time right here to show Fred? Because Fred's saying, is there a fee that comes off of the premium? And I think this is a good example. We're
yeah,
looking at what Dave Ramsey always beats up, a regular off-the-shelf whole life. Now, Fred, this is not the policies that we design. We design specially designed high cash value policies. But this person in this example puts in 10,155. Go over there to the cash value. Zero, right? You have zero
mhm.
money to use. So what did that policy cost you? It cost you 10,155 to get a death benefit of 846. In a second, Craig's going to show you another one. When we design these, we design them for maximum cash value, okay, early on, and also maximum growth. So the policies we design, unlike this policy he's showing, they have much lower costs because we're going to put the lowest death benefit on to get the highest cash value. We're going to reduce our commission between 60 and 90% by the way we design it, so that 60 to 90% that we give up in commission is immediately going to show up immediately in the first 30 days within your policy, which Craig will show you. So the fees, the costs, which are three of them: policy service fee, which is about $50 to $100 per year. That we can't get away from. That's the insurance company's charge. The cost of insurance for the death benefit. Okay, here, the cost of insurance for 846,250 was 10,155 because you had no growth or some variant of that. Now, the third cost would be the commission. So we can't really control the cost per $1,000 of death benefit. We can't control the policy service fee, but unlike many advisors and agents that will tell you they can't control their commission, they sure can in the design. So Fred, there are those three costs, but now in a second, Craig's going to show you how we reduce those costs so that you have more benefit and how that works for you in the future. Thanks, Craig.
You bet. And Catherine's asking about an 80-20. Well, here's an 80-20, meaning what do we mean by 80-20? Well, 80% of this $10,000 is going into the cash or what we call the paid up additions rider. The rest of it's going into that base. Now, there's some remarkable differences between these two. We're still putting in the exact same amount of premium. Look what happened to the death benefit. It went from 860 some thousand to 164. So we're giving up over $700,000 of death benefit. But what changed? We're taking most of the premium and putting it into the paid up additions rider, which is then creating a high cash value within the first 30 days. So if I funded all of this right away, within about 30 days, I'll have, close to $8,000 available to take out to do something with, to take a loan. So you should quickly see there's a big difference between what I just showed you and what I'm showing you now is high cash value, low death benefit, and that commission part of what we're talking about is going to be significantly reduced because this death benefit was significantly reduced. So you're really giving up death benefit for cash value. And in terms of building a banking system and something we want to build so that we can finance a car, we can finance our children's college, we can finance new windows for our home, whatever that's going to be, or we might use it for opportunity funds. by end of year three, we've put in 30,000 and we have 28,000 versus in the previous one, we only had 5,000. We're breaking even in this design by year six, not year 17. So not that this is the particular design you would want, or this is the exact numbers you're going to put in, but fundamentally, these are the things that are happening in a traditional design versus a specially designed. Well, we're going to move on. So this is a policy design. Now, what we want to do is think about go back to what Steven and Chris had been sharing about. We have a $40,000 car purchase coming up. Maybe we have that 40, 50,000, whatever it's going to be, sitting in a high yield savings account. Maybe it's in our bank account, checking account. It doesn't matter. And then the other thing we want to talk about is we're really talking about someone who is a saver. So if we go back to the slides, you remember this one where somebody is saving up money and then they're spending it, saving up money. Well, aren't they putting that savings somewhere? They're putting in their savings account. All we're talking about is we're going to save it into this whole life policy, the specially designed whole life policy, leverage it, repay it. So we're going to look more like this over time versus this over time. Okay. So now let's go. I've got another policy design here, and this is the one I want to use for our example today. You might look at that and go, well, I don't have $50,000. I don't have $3,000 a month to save. That's okay. Maybe it's 10,000 you put in, and maybe you're putting in 500 a month. The numbers really don't matter, but I just wanted to show you this behind the scenes because this is what I'm going to use for the example. So we have a policy design where my good friend Bucky Doe is putting in a $50,000 one-time dump in, and then every month he saves $3,000. And so his policy looks like this, where he's putting in 86,000. There's going to be plenty of cash value here for him to take a $40,000 loan. Or if he wants to do a 50,000 or a 60,000, he can. So what we've done is we're just simply putting more into the policy. We're going to have more cash value. Our death benefit's going to be bigger because we're putting more in. So we'll go and talk about how do we use this now. All right, so I'm going to jump over to what we call our loan officer. And earlier, Chris was showing you math of, hey, if I take a $40,000 loan at 5%, what does that look like? Now, the first thing I want to do is take this out of the picture for just a minute. And let's talk about how these policy loans work, because this is important to understand. If I have a $40,000 loan at 5%, how does that actually work? So let's go down and look at the table. Right now, I'm not making any payments on that loan. So you'll see that my principal balance remains 40,000 throughout every month. What the insurance company is doing is looking at our ending balance and saying, all right, what's my interest cost for that month? Well, at 5%, I'm going to do 5% divided by the 12, and I'm going to come up with the interest cost for the first month is $166. Then by the next month, we're up to $3,333. Well, it just so works out that 5% of the 40,000 is 2,000. So there's your 5% interest cost. That $2,000 would go to the insurance company as a loan repayment. But this isn't what we're doing. We're going to go into our loan and say, let's take a $40,000 loan at 5%. Now, this is where it kind of comes in. Do you want to make a 5-year loan? Do you want to make a car payment of $500, $700? But if we just went in and said, I want to do I want to pay this off in 60 months, that would mean we would be making payments back to our policy at $756.09. It just calculated it for us. That's what it's going to take to pay this loan off in 5 years. Now I want to go back down to the table and show you what's going on. Here's our first payment, $754.84. Well, it reduces the principal by $754.85. We calculate the interest. Next month, we put in $754. We just keep reducing principal by $754. So instead of that $2,000 of interest that we accumulated, we're now only accumulating $1,754.67 because of the simple interest calculation that the insurance company is doing, and they're just setting that interest to the side, so they're not putting it onto our principal balance. So This is a very efficient loan. I'll just put it that way. Now, here's a quick trivia question. If my loan cost is 5%, am I really paying 5%? And I just showed you the numbers, so we should all know the answer is no. But what did I pay for the cost of this loan? Well, my effective interest rate was 2.47. So I didn't really pay 5% for the use of this money. I paid 2.47. Now, let me take you back to this picture. Haven't we been talking about that this green line is our compounding, our uninterrupted compounding? What if I could show you in different points of life where maybe we start the policy, maybe we're not efficiency, at our efficiency points, we're still kind of down here where we've put in 50,000, we don't have a full 50 to use, so we're not quite efficient yet. But what if I took a policy loan 5 years later, 6 years later? What is this number on this green line? What is this number on this green line? So every time I use my policy and pay it back, what is that green line? So we would all agree we have compounding going on in our policy that we haven't stopped. And let me just go back to this real quick. This growth that's happening in the policy every year, we are not stopping this growth when we take a loan. So if I take a $40,000 loan at year 5, in year 6, I'm still going to grow the same. That's with policies that we typically put out there is called non-direct, meaning our loans are not going to impact our dividend crediting and our growth. So anyway, the reason I want to mention that is we're not going to stop this green line from going up when we utilize a loan. And so now it's time to go see what that looks like. All right, so now we've put the 40,000 in, 5%. We have a loan structured at 60 months. We're going to pay $754.85. Our effective interest rate is 2.47. But what I want to show you is what the growth looks like in the policy. So I've gone through already and picked this policy that I shared with you, the one where we put 50,000 in at 3,000 a month. That's what we're going to use for our example here. Now, here's what we're doing is I'm just going to first show you what it looks like paying it back at 5%. So I took a 5% loan, I'm going to pay it back at 5%. That's traditionally not what we do. We say, what would it cost me to finance this at the bank? What would it cost me to finance this at the dealership? So I want to first show you what it looks like at just paying 5%. All right, so the interest cost of our policy loan was $4,936.65. Over the course of 5 years, because we were saving $3,000 a month, and don't get wrapped around the numbers, maybe you're saving 500 a month, maybe you're saving 5,000 a month, that doesn't matter, but we're just showing for this particular policy over 5 years, we put 230,000 in and we grew to 231. So you might look at this and go, whoopee. I made a couple $1,000s in growth over the 5 years. Whoopee. What happens with these policies is we think long term. What didn't we lose during this 5 years? Can anybody tell me what did I not lose during 5 years when I put that 230 in? Stephen was talking about it earlier. There's something called opportunity cost. I didn't lose the opportunity cost to grow this money. So all of this premium, although it hasn't grown all that much in the first 5 years, in 7 years, 10 years, 15 years, 20 years, it's going to get bigger and bigger and bigger. But here's the question I have. If I were to do this financing and I pay this back, let's say instead of 5%, I can get a 7% car loan at the dealership. What I'm really going to do is look at what is the cost or what is the benefit of using this policy. So we already looked at the premiums we put in, we looked at what we gained in cash value growth. But I want to draw your attention to this thing called recaptured. Essentially, it's a number, it's a metric we're calculating to say, for every dollar we financed, what did I actually get back in using this system? So I'm putting in my savings, I'm borrowing, I'm paying it back. We're able to recapture for every dollar of financing 99.8 or 99 cents of every dollar. Let's call it 99.8 cents of every dollar. So the question I have is, would you be okay financing your first car, financing a car with your policy when we just start it and get 99 cents back? Or would you rather take the $40,000, finance it with a bank or a dealership, pay 7,500 of interest and lose $47,000? So if we finance it, we're losing $47,000. If we use our own system, we're actually getting back almost everything we put into the system for the first round. Now, if you do cash, we'd have to say, well, what did that 40,000 cost me by not allowing it to compound in 5 years? What did it lose compounding in 10 years and 15 years? And then just like Steven showed you, what if we buy another car? Now we've got 80,000 that were missed out on compounding. Then we lose out on 120,000 of compounding. So this just gets worse as time goes on if we don't start capturing these dollars.
If any of you are interested in booking a call with us, just to kind of run through your scenario. Craig's doing this, but we could do this for your exact scenario, whether it's paying off debt, buying cars, buying real estate, private lending on real estate through Private Money Club. Like, just book a call. When you book a call with us, it's a free strategy call. The only thing we're going to accomplish on that call is what problem are we solving for you? We're going to go right into that. We're going to get right into what it is you want to have happen. Hey, I want to do that with the cars, or hey, I want to pay off my debt faster and build wealth at the same time, or hey, I want to use this to fund my flips in real estate. Perfect. This software, the Vault, can run any scenario for anyone and show you the mathematics, and we will do that for you. But you got to book the call first. So, Craig, that's about the only thing I wanted to say.
Okay.
Let's carry on.
All right. So I want to just kind of reiterate this 231 number. This number, let's go back to this graph and let's just say that we are right here in our green line. So we've been putting in money, we've paid back our first car, second car, whatever it's going to be. Let's just say we're right here. Now, why are we only right here? Why are we not up here? Well, it's because, and this is just something we all need to realize, there's a little bit of inefficiency in these policies when we first start them. And here's what I mean. If I've put in 86,000 and I have 77,000 available, did I get everything back that I put in initially? No. Well, and that's why we're showing a cumulative return that isn't positive and what we call a cash on cash return that isn't positive. And so what does cash on cash mean? Well, if I put in 36,000 in year 3 and I grow 37,476 because of the previous years of compounding, I'm now efficient on a year by year basis. I'm putting in 36, I'm getting 37. So I'm getting about $1.04 back for every dollar I put in the system. So it took me in this policy 3 years to get efficient. And that's why when I showed you that we put in 230,000 by the end of year 5 and we had 231, well, we're just getting that flywheel of efficiency spinning. But guess what? Time's going to pass. And we get down here to year 15 and we put in 446,000, we have 648. Or we put in 7,200 in premium and we grew 37,000. This is the long-term benefits of what we're talking about. So now let's say that we jump down a few years and we start, let's say we're going to buy a car. If this is 2026, 27, 28, 29, 30, let's say by year 5, we're going to now buy our second car. So we're starting here. We're already in our efficiency standpoint. So I now want to show you what does it look like if I go into my loan. You see this loan start date, it was basically today. Well, what if I started this policy today and now a few years down the road, I want to borrow from this policy and fund another car? Well, now we've put in 180,000 of premium. We grew 200 up to 235. So let's just do the 235 minus the 180. That's $55,000 of growth. Are you okay having a policy interest cost of 4,936 while growing 55,000? Because that's just what happened. And if we go back here, we can see it in this, we started here, we went from here to year 10. So we had almost $55,000 of growth. And so the real point is, as these policies get more and more mature, as time passes, and we continue to buy more cars, we continue to fund more major purchases, vacations, home improvements, wouldn't you rather have your money just in here continually compounding and growing and compounding and growing? Because here's the beauty of it. Now that we finance that next $40,000 car, we end up getting $1.28 back for every dollar we financed. And it just keeps getting better and better and better. And so anyway, this is kind of what I wanted to share. And we can even bounce this another few years and just take this up to say 2035. And we can keep it, just see it. It's now we put in 64,000 premium, and now we're up to 186. We're now getting $2.70 back for every dollar we financed. So the whole point is it starts off slow and it just gets more and more efficient, more and more benefit as time goes on. But here's what I always say in my strategy calls. If you put in 86,000 and you didn't live more than 2 years, let's say in year two, something happens, you pass away. Are you okay with the fact that you put in 122,000 of premium, but your family gets 1.4 million? And that's a question we should all ask. Are we okay if I put in 122 and my family gets 1.4 because I didn't make it past year two? Yeah, sure. We weren't efficient, but I think that certainly answers that question. Now, let's say that you live to be, I don't know, let's say we make it all the way down here to 80 years old. You have 2.35 million of cash value. You have a death benefit 2.7. I mean, there's just no other strategy that I find that's a better long-term strategy to go on. And let's go look at age 65. What if you use this policy throughout your life to buy cars, to pay down debt, to fund college, pay it back, renovate your house, pay it back, and when you get to be age 65, you have $1.1 million of cash value. What could we do with this $1.1 million of cash value? We could use it for supplemental retirement income. And guess what? When we use this money, it's not taxable. If we're taking loans or we're doing withdrawals, I have up to $518,000 in this particular policy that I can pull out cash tax-free, or I can take loans, which are never tax-free. And as I'm using this for retirement, maybe I'm pulling some money out when the market's down, or maybe I'm using it to finance, things I want to do in my retirement. It's just incredible amount of flexibility. And, it's just one of those things where we're going to use this over and over and over. We're going to pay it back. We're going to use it and pay it back. And then at some point we can switch to a retirement strategy. The Lois is asking if the cash value is tax-free. So when we design these policies, we're going to design them so they aren't taxable entities. All of this growth that's happening is tax-free. You're not going to get a 1099 for any of this stuff. When you take a loan, you're not going to get a 1099 for that. And when you get to retirement, if we're looking at this $1.1 million here, we can withdraw from the contract up to $518,000 tax-free because we're just getting our cost basis back. But as soon as we go to the 519, the next dollar, 519,000, that can become taxable. But guess what we do? We just switch to loans at that point. So there's a lot of really, really cool strategies. It's not just it's just not a one, time thing that we're doing with these policies. We're using them through our whole life and then leveraging them for retirement strategies, estate planning, legacy. There's all sorts of cool things we can do as we get down here in the later years. So with all of that, any questions? I'm happy to go back into anything I've covered in more detail because I know sometimes we get to moving a little bit fast, but just want to make sure that the premise is there that we can put our savings in a better place, have uninterrupted compounding, leverage that for major purchases, pay it back, keep compounding, leverage it, pay it back. And really, I think the ultimate question is, do we want to have a picture that looks like this? And I actually had a strategy call where, and I don't remember the numbers, but the gal on the call said, "This is about how much I've made throughout my working life." She was getting close to retirement, and it was a pretty big number. And she was just kind of somber and says, "But I don't know where it went." Let's say you've made 2 million in your life, you've made 3 million in your life, you've made 100, you've made a million in your life. This is the problem. People save the money and spend it, save it and spend it, save it and spend it, and they're always ending up at zero. So this is life-changing because although we're giving something up in the beginning, this thing is just beautiful down the road. And like I said, even if we're giving up something in the beginning and God forbid something happens to us and we pass away, well, we already multiplied our exit because we may have put 122 in and we walk away with our family walks away with 1.4 million. So I don't really see any disadvantage to this little downward piece that we have to deal with here in these first few years because I'll trade that any day for, being up here.
Hey, Craig, there's a couple of things I wanted to hit. Rick, did you already hit Rick's question? I stepped away.
I have not. I didn't see Rick's
So Rick's
question.
question is good. It's kind of straight out of, Dave Ramsey.
Okay.
Where Dave Ramsey always says, "Oh, they keep all your cash value. You just get the death benefit." But what Dave Ramsey and Dave Ramsey knows this, and so do all his cronies. So Rick, the question is, what happens to the account at the end of life? Specifically, what happens to the money in the paid up additions rider? This is a really important thing to discuss. Because contrary to what Dave says, "Oh, they keep all your cash value." He's not wrong, but he's definitely not right. They don't keep your cash value. Your cash value, well, first off, your premiums that are going in the way we design them, a large portion of your premium goes to paid up additions. The paid up additions increase your death benefit, and so does the cash value of the base. But let's just focus on paid up additions. So when you put money in, and Craig, you can pick any period of time here. I just want to show him. I mean, you can go to the first year. That'd be one to look at. So here, we grow our cash value that first year. So our death benefit starts at 154,770. But the second year, because you're putting money into paid up additions, look what happened to the death benefit. It went up. Jump down 10 years. So in 10 years, your death benefit didn't just go up, it went up a lot. Okay. And then if you keep going, the further down this we go, you can see down here, we start getting 400, 500. We started with $100,000+ policy. Now, by the time you're likely to pass, that's a little crazy. I don't know many people are going to live to 121, but let's say 90 years old, Craig. I think that's pretty
Okay.
fair. And Rick, is that fair? Like 90? At 90 years old, right here, you've got $1,098,143 death benefit. You didn't pay for $1,098,000, okay? It grew because your cash value went up. And one thing you need to know is we're building these policies for high early cash value. This is what sums it up. At 121 years old, which is kind of that's the age they kind of make us stop these. And at that point, if you live past 121, just look at that death benefit. What is that? 3.1 million. They're just going to write you a check. The downside is if you make it to 121, that's taxable. So try not to make it to 121. But just saying. So like, look at how we went from 100 and 187, I believe it was, and throughout the
164.
164, and throughout the cycle of it, the death benefit went up. That's because of the paid up additions and the growth of the cash value. How these insurance companies work from an actuarial standpoint is your cash value can never exceed your death benefit until age 121, when at that time, the cash value is equal to the death benefit. So hopefully that explains it. It's kind of a simple way of explaining it, but to answer the question honestly, no, your cash value does not get paid to you in addition to your death benefit, but your cash value going up drives your death benefit. And because we're building these policies to grow the cash value faster, your death benefit goes up faster. I know it starts lower, but we get there pretty darn quick. So hopefully that answers your question. Rick, I'm going to go rapid fire on a few of these. Lois, over in the Q&A.
Chris, just one quick thing I want to add to that, because this is kind of how I think about it in my mind is there's not a separate thing called cash value and death benefit. They're kind of one and the same because what they're doing is they're saying you have $164,000 of death benefit. We're giving you access to 8,410 of it right now in year one. And the reason we know that's true is if I take that 8,000, let's say I take $8,000 and I die, they're simply just going to write a check to the family for 8,000 less than this number is. And so as we continue on, isn't cash value really just the amount of death benefit that we have accessible to us? And when you look at how this progresses, this cash value and the death benefit are working their way to be equal. So if they pay this out, aren't they really just, I have $3.1 million of death benefit. They're going to write me a check for 3.1 if I make it to 121. So all the cash value is a ledger amount that says this is how much you have available. And one thing I want to mention too, because we've had this on strategy calls before where somebody misunderstood and they said, hey, if I put in $10,000, this is really cool. I can take out a loan for 160,000 because that's my death benefit. Like, no, you do have a $164,000 death benefit. What's accessible is what's showing on this cash value number. And so it's a misconception. And frankly, if the insurance companies let you put in 10,000 and take 164, they'd be out of business tomorrow. But these are some of the things, and I'm glad that Rick, you asked that, because Dave Ramsey throws a lot of things out there, confuses people, and there's not a separate cash value and death benefit thing. It's just really how much cash value is available to you early out of your death benefit. That's really what's going on.
And I'm going to use that misbelief with another one. Kevin had said, is this better than an IUL, an Index Universal Life? Usually the policy type you hear in infinite banking. So he's basically saying, normally in infinite banking, you hear IULs, which is really strange to hear that, Kevin, because IULs are forbidden to be used with the infinite banking concepts. And that comes not from Chris Naugle saying it or Craig or Steven. That comes from the Infinite Banking Practitioners Organization, the only certification that you can get as an infinite banking practitioner. So think of it like, you've got tax preparers at H&R Block, and then you've got CPAs. Does a tax preparer need to actually have the license and the certification to be called a CPA? No. Okay. But wouldn't you rather a very good CPA who went to school with that, has the certification, has the license to be a CPA, wouldn't you rather them do your tax returns and actually do tax planning? Yeah, because H&R Block isn't doing your tax planning. So when you look at it over here, that's the Infinite Banking Practitioners Organization. That was founded by R. Nelson Nash prior to him passing, and that is the guidance. Okay, now, two more things, Kevin, to kind of go into IULs. I don't want to beat it to death today, but IULs, just by the sheer nature of how they are built, the chassis they are built on. I've been doing this 23 years. I can dissect it too much. Do not inherently work for infinite banking and won't. There are surrender charges in the early years. Even if you design it to maximize the cash value, you can't use as much in an IUL as you can a whole life. But the big material difference is the way the cost of insurance is calculated. In this model that you're seeing with whole life insurance, the cost of insurance per $1,000 of death benefit never changes. It is level from day one to day 120 or year 121. Okay, in an IUL, you are guaranteed that every year you get older, your cost goes up. Now, that might not be a problem in the early years, but in the later years of the IUL, that's going to chew up all the benefits. So if you're using your IUL for infinite banking, the surrender charges, the cost of insurance layout, and just the general nature of what IULs were built for do not coincide with infinite banking. You can read it in the Infinite Banking Practitioners Manual. They forbid us IBC practitioners that are certified to use IULs. It's not because they got a vendetta against IULs. It's because their economist, did all the math to prove they don't work. So when you hear people using IUL and infinite banking in the same, just literally realize they are absolutely telling you a false story and a bill of lies. That's all it is. And I will fight anyone on that topic because it is absolutely mathematically proven. So let's keep going here. I don't want to talk any more about IULs, but Lois had said, so loans are taxable, right? No, loans that you take are just like a loan. So if you had equity in your house and you took a home equity line of credit and you use that home equity line of credit to go on a vacation, did you pay tax on that line of credit? That loan? No, this is the same way. The loan you're taking is in advance of your death benefit. Your death benefit, when paid out upon death, is tax-free. So the loan is also benefiting from those tax advantages and is tax-free to use. That's a really good question. Actually, Lois, that's the first time I think anyone's ever asked us that question, but I bet you a lot of people are thinking that. Anonymous said, does this type of policy work for somebody already in their 60s? I want to debunk another thing, and we hear this all the time. I think there was 3 people so far just today on this webinar said, I'm too old, alluding to I'm 55. Is it too late for me? And Anonymous, you're saying, if I'm in my 60s, am I too old for this? Not at all. We have over 7,000 clients, and I don't have the math in front of me or the statistics, but most of our clients are between 50 and 70 years old. This works just fine up to 70 years old. It even works after 70. Our oldest client that we ever did this for, she's often on here, Claire, she was 74 years old, uses IBC for all of her stuff still to this day. But death benefit for her was more important than the cash value. And if you're older, like I'll say, high 60s, early 70s, death benefit's got to be the primary cause or reason you're doing this, not the cash value, because there will be a difference. Okay, but the difference really doesn't affect the cash value as much. Lois said, what are the requirements for a specially designed whole life policy? I would say you just book a call with us and we find out what it is you're trying to do, how much you want to save within the policy, and what the goal is. And then we will do all that on a call. So I'd say that's the easiest way. These questions are awesome. And Craig, I'm going to turn it over to you in a second. Obidima, for instance, I want to buy a $40,000 car. Does that mean I will have to pay $40,000 yearly as a premium to the vault? This is a really great question. Craig, do you want to answer that one? Because that is definitely not the case.
Yeah, let me bring up I'll just bring up one that has a dump in here. So here's a policy where we're doing a $20,000 dump in. It could be 40, could be 50, but you'll see there's a big chunk of premium going in year 1. That's what we call a dump in. So it's kind of a one-time funding so that enough can go in so that if you had 40,000, 50,000 saved up, we can dump that in the policy. And then we have this ongoing premium. So you'll see 20,000 dumped in this policy plus 62, 65 a year going in. So the answer is no, you don't have to. You can do a big chunk one in year 1 and then scale down in subsequent years, just like I'm showing in this policy.
And then the second part of that question was, what happens when the individual dies in the 2nd year of paying premiums? The family gets the death benefit.
Yep. So what would happen is, let's say in this policy, there was maybe you had a $20,000 loan out and they die. Well, instead of 355, they're going to be at 335. So they're just going to take any loan that is outstanding, they'll take that off the death benefit, and then the rest goes to the beneficiary.
Yeah, and tax-free too, which is important.
Somebody else also asked, what if I have a home equity line of credit? I was just responding to Catherine. If I have a home equity line of credit, could I use that to fund my policy? Now, this is a question that comes up all the time. This is something that we've been doing for the better part of 10 years plus, using home equity lines of credit or all-in-one loans or first lien HELOCs as a funding mechanism for that initial dump in deposit, that excess premium dump in. But here's the thing. Like, for us to just sit here openly on a webinar and say, yes, that works for everybody, it does not. We've seen situations where using a HELOC has put that person in danger, in a bad position. So what we prefer, and I want to be very clear about this because this is important, if you're thinking of using a home equity line of credit or the equity from your house to fund your policy, please, 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 please let Craig and the advanced services team run the math, because it is just a mathematical game. We can literally show you the most optimum way to do this using your HELOC and make sure that you're not getting over your skis, if you will, and overcommitting. Because remember, if you got a HELOC and you take money from a HELOC, you just turned the clock on for interest being charged. Then you put it in the policy. Great. Then you take the money out of the policy, and now the insurance company is charging you interest on that. So it is very important that we understand the use case you're going to. It works probably, what would you say, 80, 90% of the time, Craig?
Yeah, it's really going to depend on your cash flow, your income minus expenses, and really what are you doing as the next step? So we're not just going to take money out of a HELOC, put in a policy, and then, then what? So typically if you're using the policy at that next stage for buying a car, it might be kind of hard to make the math all work. But Chris, you nailed it appropriately. It's just a matter of we run the numbers, we test it, and then we can see whether it works or not.
Yeah, I want to give a shout out to my friend Jason. Jason's on here with us today. He just texted me saying he's on the webinar and he's loving it. Now, Jason's in the business. Jason is one of those people out there that literally, like to Kevin with the IUL, Jason And Jason, if you can shoot a message in the chat because I want to kind of drive some people to you. Jason has created a software like one I've never seen. We're going to be doing a YouTube video on this, but he created a software that will show you the inefficiencies and the problems with an IUL, and he will show it in real life comparisons. So I haven't seen this yet, but he's got it, and he could show you why you would never, ever, ever want to use an IUL for the infinite banking concept. I'm not saying IULs are bad for all use cases. They're great for premium financing. They can be really good for supplementing your retirement, but so can especially designed whole life. It's just a matter of looking at it. So, Jason, if you're still on here, throw a chat up. But I wanted to hit that, and I love it. Unanimous just sent something really nice over here in the comments. And I don't know who Unanimous is, so let me know who you are. But it says, I started my policy at 60 and a half years old, and I have basically paid off all of my credit cards in 7 months. That is not somebody from our team, folks. That is not some false claim. That is somebody that literally applied this and it worked, and we can show you how it will work for you. So just book a call with us. Give us your phone number. We'll text you, or just give us a call at that 866 number. I'll put it up there again. Not to sound salesy or anything, but sometimes people miss the opportunity because they don't act. And that is exactly it. Take action, because that's the only thing that will change your life. Education and knowledge means absolutely nothing without the application of what you just learned. So the only way you're going to apply this is getting on a call with us. Let us walk through your scenario, your problem, your goals, and run your numbers instead of just like us doing general stuff, which is fine. But I always like to tell people, like, we want to solve your problem. We don't want to solve anyone else's problem on a call except for yours.
Yeah, and that was our good friend Ricky Gant. So
Ricky, there we go,
yeah,
Ricky.
yep.
I love it, love it.
So
Could
Chris,
we work with someone in Canada? Yes, we can. Our team is not licensed in Canada. There's some unique things going on. I'll explain in a second. But we have people in Canada that are IBC practitioners that we would send you to. So just send us your number, Sonia, and we'll get you to the right people over there that are trusted by us to do this the right way for you.
And I was looking up in the chat, there was a couple of questions from Stephen Metropolis I wanted to address as well. And I think he was referring to this policy. He's saying, so in year 6, would I have access to the 60K that I put in for the last 6 years? So in at the end of year 6, let's say you've put in the 60,930 and you have $62,018. The insurance company is not going to let you take 100% of this number, but somewhere in the 90, and probably as you get to year 6, it's going to be closer to 95%, maybe even higher. But yes, you're right. Once we get to, here we put in 60, we can probably pull out maybe 56, 57 at that point. But that's just going to continue to get better and better as far as what you have access to. And then Stephen also had another question. Is the interest on the loan a tax write-off? Chris, do you want to cover that one?
Is the interest on the loan a tax write-off? So you'd have to consult with your CPA. And there's two different ways. So my CPA, if I brought him on here, his name's Mark Yeager, very well-known CPA. He would explain all the ins and the outs. It's complicated. Okay, it depends on how you're using it. Is it business owned or is it personally owned? But just rule of thumb, typically the interest on the loan, okay, charged to an individual is not a tax. You can't write that interest off. There's rare situations, again, that's why I always defer it over to the CPA, because we can't give you tax or legal advice. So you'd have to check with your CPA. Maybe I'll get my CPA after tax season to do a YouTube video that we can kind of walk through that topic alone. I like that idea. Can you use this to pay off a mortgage? Whew, Craig, does this work for paying off mortgages too?
It does, and we have to kind of work the numbers to make sure it all flows and works well. So absolutely, we have this thing called the Debt Blaster, and that's where we model paying off debts and using HELOCs and all that cool stuff. I did want to add one more thing to Stephen's question about, is the loan interest taxable or tax deductible? Let's say that I'm a business owner and I have a personal policy, and I take a loan personally from the insurance company, and then I write a promissory note to my business. So I am the bank to my business. And like Chris said, make sure this is all kosher with your CPA. But the idea would be, if I'm loaning money to my business is going to be paying me back. The interest that business is paying is tax deductible in that business. the interest cost coming back to me personally is interest income. So you have to kind of look at the trade-offs there. But validate all of that with your CPA. I am not a CPA, but that's what we've seen work in the past is personal policy, personal loan, promissory note, loan money to the business. Business pays me back, I pay the policy back. So that would be a path.
And the other thing too, I didn't think we'd go this long, but I did a video, and this is just kind of a wrap up on everything we're talking about here because we're just about at time. Um, I've had a lot of cars, and I like cars, and I bought lots of different vehicles, expensive ones, inexpensive ones. But there's one example that I did, and I did a YouTube video on this. It's you can find it on at the Chris Naugle, and it was about a G-Wagon that I bought, and I bought this during COVID. Anyone remember what the price of cars were during COVID? So they were severely elevated. So I overpaid for this G-Wagon, but it was exactly the vehicle I wanted. But the reason I didn't care that I overpaid for it is I knew that as long as I financed it with my own private banking system, I would eventually get all the money back for the vehicle. So a unique thing happened, and I did a whole video on this. It was a $170,000 vehicle that I bought in 2024. I made payments back to my policies for $2,931.28. The reason I came up with that's kind of a weird monthly payment, right? Well, it's not. I went online and I said, what is the cheapest interest rate I could get on this vehicle? And the cheapest I could find was 7.4%. So I just repaid myself back at 7.4% because that was what, and it was Ally Bank was the cheapest back then. That's what they were going to charge me. So in doing this, not to go long into this, but the economics over the 6 years of this thing, I actually ended up making money on this truck. But the thing that's important to understand is I actually sold this truck at a loss. I sold this truck for about $130,000. I'm not going to go through all the numbers, but here I broke down the amortization schedule. I broke down the policy loan with the interest. They were charging a little under 6, but I rounded up to 6 because I didn't want anyone saying, "Oh, where can you get a 6% loan?" So I rounded it up. But I bought the G-Wagon in January of 2024 for 170. I sold the G-Wagon 2026 for 130 and change. I lost $39,761, but I didn't lose anything, because I financed this vehicle through my own private banking system, because I made the same payment I would have made to Ally Bank back to my policy. Even after paying the insurance company interest, I ended up profiting $12,270. And that does not include, if I'm not mistaken, that does not include the interest I would have earned on the $170,000 that I took out. Because remember, I took a $170,000 loan for my policy, but I still had $170,000 earning in my policies. I didn't know what that interest rate was, but I estimated it. So I profited $12,270 without the cash value growth. I just kind of guesstimated the cash value growth, and I just did it at a 5% IRR because, like, I didn't want to get beat up by any of the other pundits out there, the other people that love to hate us. So I just said 5% because that's a really fair number. I think I made way more than that. On 170 grand over that exact time frame, that's another $18,174. So if you really added it up, I made $30,444 selling a vehicle at a loss that I only drove for whatever that time frame was. So listen, like, you can look at this any which way you want. I've done this so many times with so many vehicles, and so has my team. I mean, Marius, we just did that video we played in the beginning. It works, folks. It works every single time. The only way it doesn't work is if you fail yourself. And I'm going to be very clear about that. If you are not an honest banker, if you fail yourself, which basically means you're just cheating yourself, you're treating your money differently than you treat the bank's money. You're not valuing your dollars in your banking system the same way you value a bank, which is completely maddening to me because it makes no sense. Why would you want the bank to make money on you, but yet you don't want to make money yourself? But you're willing to pay the bank, but you don't want to pay yourself back. So you've got to be an honest banker. That is the only way this fails, folks. I got to be very clear. The only way it fails is if you fail yourself. The system, my team, the policies, they will never, ever fail you. It is guaranteed because we're dealing with a guaranteed product. So I didn't mean to kind of finish with that, but it's super important. Like, I just used this G-Wagon example, but we could do any of the cars I bought throughout time, and I could show you. There wasn't a single car. Maybe the first one I did, I lost money on that car, but I probably got like 90 cents of every dollar back on that car. The first one's the only one that would ever happen on, because over time that compounding takes effect. And you're never going to just buy one car. But even if it was only 90 cents of every dollar, imagine that. You buy a car. You do it through your own banking system. 5 years later, you got that car in the driveway, but you've gotten 90 cents of every dollar back that you paid for that car, and you didn't sell the car. Would that be a win for you? You'd be doing backflips, well, or hitting your head one way or the other, but you'd be trying to do backflips in the driveway because you'd be so thrilled, like, honey, look, we just got 90 cents of every dollar back for this car. It barely costs us anything. And hell, if we sell it today, we'll make money, but let's just give it to our daughter, Susie, right? Because now that car barely costs anything. And then the next car they buy, they are going to get all the money back by doing this. Now, it doesn't mean the car is free. I want to be clear about that. We're not sitting here telling you that there's a way to get free cars. We're just telling you that there's a way to get all the money back by changing how you buy cars and applying this system. That's all this was today. It was literally a very simple exercise showing you that using cash can sometimes be one of the more expensive ways to pay for a car. Using this system, the infinite banking concept, is more efficient and effective in the long run, 100% of the time. Contrary to what any joker says on social media, let us run the math for yours, and you will see every single time that this works. Craig, anything you want to say on that?
No, I think you nailed it. And it's really opportunity cost. It's uninterrupted compounding. There's tax advantages. There's, to the growth. You're not going to get 1099. So it's a system that we can't find a better tool to use for the system than a
Wow.
specially designed whole life policy.
Thank you so very much. And the other thing that I thought was a remarkable number is in the course of a month, we help 600 plus people just on this webinar. That's how much impact this has. And I just want to give a huge shout out to each and every one of you. And then all the people that will watch this on YouTube, that's even better. And the last thing, a lot of you gave us your number. We're going to send you a text if we haven't already. And if anyone else wants to get a hold of us, just give us a ring. Anyone on YouTube, just call that 866 number. Super easy. And we will have a ton of fun. All right, folks. With that being said, I appreciate all of you, and we'll see you on the next one.